In the world of macroeconomics, crises rarely emerge from a single fault line. Instead, they form at the intersection of structural imbalances, policy mistakes, and unforeseen shocks. And as we move closer to 2027, a growing number of economists quietly acknowledge a disturbing pattern. The global financial architecture is entering a phase of elevated fragility, eerily reminiscent of previous pre-crisis periods. The warning signs aren't loud. They're subtle, numerical, technical, but undeniably present. To understand why 2027 is shaping up as a high-risk year, we must look at four converging forces: monetary tightening lag effects, sovereign debt saturation, corporate refinancing cliffs, and demographic-driven demand compression. Between 2022 and 2024, central banks worldwide implemented the most aggressive tightening cycle in nearly half a century. The Federal Reserve raised rates at a pace not seen since the Volcker era. The European Central Bank abandoned negative rates for the first time in a decade. Even emerging markets like Brazil, Chile, and India executed historic rate hikes to defend their currencies. But rate hikes don't break the economy immediately. They break things 18 to 30 months later, when refinancing windows open. This means the true economic impact of the 2023 to 2024 tightening cycle will arrive exactly around 2026 to 2027. The corporate sector, which became heavily reliant on near-zero debt during the free money decade, faces a massive refinancing cliff. Nearly $3.2 trillion in U.S. corporate debt will mature between 2025 and 2027, much of it issued at historically low yields. Refinancing this debt at rates 200 to 400 basis points higher will compress margins, trigger layoffs, and in weaker firms, lead to insolvencies. In Europe, the situation is even more precarious. The continent's corporate credit market leans heavily on bank lending rather than market issuance. Higher rates directly impact working capital facilities and revolving credit lines. European SMEs are particularly vulnerable, forming what analysts call the silent default wave. The delayed effect of tightening is the first pillar of the potential 2027 crisis. Next, we turn to sovereign debt. The United States, Japan, Italy, France, and the UK have entered a phase known in macroeconomic models as debt saturation, a point where incremental debt delivers diminishing economic returns while significantly increasing fiscal fragility. By 2027, the U.S. debt to GDP ratio is projected to surpass 125%, a threshold typically associated with declining investor confidence and rising term premiums. Interest payments will approach $1.4 trillion, making them the single largest line item in the federal budget. Japan, the global outlier, carries over 260% debt to GDP. But its unique structure, domestic bond ownership and yield curve control, creates a separate set of risks. If inflationary pressures reemerge, Japan may be forced to unwind YCC, triggering a global sovereign bond repricing event. Europe presents the most coordinated risk. Italy and France are moving toward debt levels the ECB cannot backstop indefinitely. The introduction of the transmission protection instrument was meant to prevent another sovereign spread crisis, but its usage remains politically controversial. If one major sovereign bond market experiences a liquidity event in 2027, it would ripple globally through collateral markets, repo markets, and cross-border bank exposures. Beyond sovereigns, the private sector faces its own systemic challenge. Global credit agencies refer to 2026 to 2027 as the maturity wall, when an unprecedented volume of corporate bonds and leveraged loans come due. Many of these were structured during periods of historically low yields and inflated valuations, particularly in sectors such as commercial real estate, technology growth firms, private equity-backed companies, high-yield industrials, zombie corporations kept alive by cheap credit. Commercial real estate is the most fragile. Office vacancy rates across major metropolitan areas, San Francisco, London, Toronto, Dubai, and Frankfurt, remain structurally elevated. As older leases expire, properties must be refinanced into higher rate environments with lower cash flow, or this combination is lethal. Asset managers at BlackRock, PIMCO, and Fidelity have already issued quiet warnings. The refinancing risk for CRE is material and underpriced. If CRE defaults accelerate, the impact will hit regional banks first, then propagate through credit default swap spreads and funding markets. The fourth risk vector is demographic. By 2027, the global economy will enter a new structural regime where aging populations suppress consumption growth while increasing fiscal burdens. Consumption elasticity, the responsiveness of spending to income changes, is declining across developed economies. Key drivers include aging populations with lower spending patterns, declining household formation, slowing immigration in Western economies, reduced productivity growth, a shrinking labor force participation rate. Demographic economists warn of a secular stagnation trap, where the economy becomes chronically unable to generate sufficient demand to absorb productive capacity. This reduces GDP growth ceilings and amplifies the impact of any shock. If a financial event occurs in 2027, it will strike an economy already weakened by demographic deflation. Putting it all together, why 2027 is high risk. Each of these four forces, tightening lag effects, sovereign debt saturation, corporate refinancing cliffs, and demographic compression, is dangerous on its own. But in 2027, they converge. Governments will have less fiscal room. Corporations will face higher refinancing costs. Households will face weakened real purchasing power. Banks will carry more risk on balance sheets. Central banks will be unable to stimulate aggressively because of inflation constraints. And this is the exact configuration in which systemic shocks become systemic crises. While it is impossible to predict the catalyst, whether it is a sovereign bond event, a corporate default wave, a commodity shock, or a geopolitical escalation, the underlying macroeconomic architecture is fragile. 2027 may not mirror 2008. It may not mirror 2001. It may not mirror 1997. But in terms of structural risk accumulation, it shares elements of all three. And for global markets, that alone is enough to warrant attention. While the four macroeconomic vectors, monetary lag effects, sovereign debt saturation, corporate maturity walls, and demographic compression, form the core of the 2027 risk architecture, a deeper examination reveals several second-order forces that may exacerbate the fragility of the global system. These forces often appear in the footnotes of institutional research, discussed quietly by analysts, but rarely acknowledged publicly by policymakers due to their politically sensitive nature. Yet ignoring these undercurrents would leave the macro analysis incomplete. Another critical dynamic shaping the global macro landscape is the unprecedented shift from quantitative easing, QE, to quantitative tightening, QT. The global financial system, accustomed to more than a decade of central bank balance sheet expansion, is now adjusting to the inverse, balance sheet contraction. This shift is not merely technical. It redefines global liquidity conditions. Between 2009 and 2022, the combined balance sheets of the Federal Reserve, ECB, BOJ, and PBOC expanded by more than $30 trillion. This liquidity suppressed volatility, compressed credit spreads, and inflated valuations across equities, bonds, and real estate. Now QT is removing liquidity at a pace unseen in modern history. The Federal Reserve is rolling off over $95 billion per month. The ECB is unwinding APP and TLTRO programs. The BOJ is tentatively discussing normalization. The PBOC faces constraints due to capital outflow pressures. Liquidity is the oxygen of financial markets. Remove enough of it, and even fundamentally healthy institutions experience stress. By 2027, the cumulative effects of QT will have drained trillions of dollars from the global liquidity pool. This dramatically increases the probability that a relatively small shock can cascade into a systemic event. Markets are no longer protected by the automatic dampening effect of central bank asset purchases. Volatility is no longer artificially suppressed. Liquidity is no longer guaranteed. Financial conditions are no longer anchored. We are in a new liquidity regime, and markets have not fully priced the implications. Another under-discussed fragility lies within the shadow banking system and the explosive growth of private credit. Over the past decade, regulatory frameworks pushed risk-taking from traditional banks into non-bank financial institutions. Private debt funds, hedge funds, money market funds, CLO managers, mortgage REITs. Unlike banks, these entities are not backstopped by central banks and lack deposit insurance. Yet they collectively hold tens of trillions in credit exposure. Private credit ballooned from $300 billion in 2010 to over $1.8 trillion today. These loans are often floating rate, lightly covenanted, opaque in valuation, marked at manager discretion, highly illiquid. In a rising rate environment, floating rate private loans generate enormous stress for borrowers, especially private equity-backed firms that depend on low yields. As refinancing stress accelerates into 2027, private credit could face surge in delinquencies, NAV markdowns and redemption pressures, forced asset sales, fire sale contagion in credit markets. Because private credit sits outside regulatory oversight, a failure here would not unfold like a banking crisis. It would unfold like a liquidity trap, spreading silently until it surfaces abruptly. Money market fragility and repo market dependence. The 2019 repo crisis and the March 2020 liquidity breakdown revealed something uncomfortable. The global system relies dangerously on smooth repo functioning. In 2027, elevated sovereign issuance and tighter collateral conditions may strain repo liquidity, increasing systemic risk. Shadow banking is the dark forest of modern finance. And in 2027, the forest is dry. Conclusion: the architecture of risk in 2027. When viewed together, these forces paint a sobering picture, not a prediction of collapse, but a recognition of fragility. 2027 is the intersection point where lagged tightening effects, sovereign debt saturation, corporate maturity walls, demographic deflation, shadow banking exposure, QT-driven liquidity scarcity, geopolitical fragmentation, dollar tightness, inflation uncertainty, valuation excesses, all converge into one complex macro regime. This does not guarantee crisis, but it guarantees vulnerability. 2027 is not a forecast of disaster. It is a warning of structural imbalance. A year where policymakers will face limited options. A year where markets will navigate thin liquidity. A year where geopolitical risks and financial fragility overlap. A year where the global economy walks a narrow path. If you want to stay ahead of what's really happening in global macroeconomics, financial markets, and geopolitical risk, this channel breaks it all down in a clear and simple way. Make sure to subscribe so you never miss the trends, warnings, and insights shaping the economy before everyone else sees them.